Hello, welcome to Trade Zone for the 22nd of May 2023. This is a program sponsored by Eightcap and delivered by Track Record Trading Academy. So let's dive into it. We'll talk about the important stuff that happened last week and the market impact that was significant and what's important this week. So what was important last week? We had quite a lot of data last week. First off, Canadian inflation, then we'll talk about the US retail sales as well. China, a slew of data from China, retail sales, labor, and industrial production. And finally, from Australia, we'll talk about Reserve Bank of Australia's policy meetings and Australian job data. So the Consumer Price Index, a measure of inflation in Canada, showed that prices rose 4.4% versus what was expectations of 4.1%. So it's higher than expected. That's not good news on the inflation front. And it was slightly higher than the 4.3% print in March. And the core index, however, declined slightly to 4.1% from 4.3 previously. Core index excludes more volatile components such as energy and food prices. And the higher inflation was caused by higher shelter cost, and that's quite sticky. Even in the US, it's the same. High shelter cost has been quite sticky at the high levels for some time now. And what's the implication for this high inflation print from Canada? It's not so good for US as well, given that both the economies are closely related. So a higher inflation print may imply that we might see the same in the US in the months ahead. So there is an increased risk of higher inflation, which will also increase the risk that the US Federal Reserve may keep to their hawkish rhetoric of keeping rates higher for longer. And also, this inflation print could discourage the Bank of Canada from keeping to its conditional pause and consider hiking interest rates further if that should continue. Of course, consolation was that the core index did tick lower. What was the market impact? We did see the Canadian dollar appreciating around 0.3% against the dollars. So dollar CAD fell about 0.34%, but the gains in the Canadian dollar did not hold. It was quite quickly reversed. And as you can see on the hourly charts, we have short-term support at 1.34, near psychological level of 134, and hourly resistance from the previous high of 135.70. So that's the short-term charts if you're looking at it on the for your short-term trading. And US retail sales rose 0.4% month on month. That was a reversal from the weak print of a contraction of 0.7% in March. What does it mean? It means that the retail sales continue to grow, but it's only at 1.6% on a year-to-year basis. So it's the US consumer continue to be spending, but not as strong as it was before, compared to the March figures on a yearly basis. But the market impact was limited, did not really have an impact on the markets, because the overriding issue that is keeping investors' attention right now is the discussions and negotiations to lift the US debt ceiling before the deadline of early June. So moving on to China, we had some data. Labor numbers showed that unemployment rate did dip slightly to 5.2 from the previous print of 5.3%. Labor situation was a major concern because during lockdowns, most of the people were kept at home. So the situation is improving. That's a good sign. Maybe not as fast as it should, but as the policymakers wanted, but at least it's heading in the right direction. Industrial production expanded 5.6% year on year. The market forecast was a very optimistic 10.9%. So, but it is still the 12th straight month of growth in industrial output, and the fastest pace since last September. So mixed number, but at least it's still growing, and it is accelerating from the 3.9% in March. What else? We have retail sales, which rose a whopping 18.4% year on year versus the expectations of 20.1%. This is a sharp increase from the previous print of 10.6%, but also it is a reflection of the economy coming back after shutdowns have been lifted due to the improvement in the COVID situation. This third straight month of an acceleration in the pace of retail sales, so that's encouraging. But there wasn't really much of an impact in the currencies. And RBA minutes, Reserve Bank of Australia, showed that they considered a pause, but they finally settled on a hike of 0.25%, and they agreed that further increases in interest rates may still be required, given that inflation remains very strong, and they do not expect it to decline to reach the top of the bank's target range of 2 to 3% until mid-2025. So that's not really good news, meaning that they will still be very vigilant and very hawkish, and likely to hike if we should see a tick up in inflation in the weeks ahead. Market impact was limited. It was not much of a surprise to the market. All the reaction to the rate hike was pretty much done by the time these minutes came out. So we did see a weak number from Australia. The economy lost 4.3 thousand jobs, so 4,300 jobs in April. This was versus expectations of an increase of 25,000 jobs. So that is very weak, and that's a big decline from the 53,000 jobs that were added in March. And unemployment rate as a result, unsurprisingly, rose to 3.7%. That's 0.2% higher than previously printed in March, and also versus the 3.5% expected. That's because instead of adding jobs, the economy lost jobs. So that's a sign that the labor market is weakening. So hopefully that translates to, it's bad news for the unemployed, but hopefully that translates to lower inflation and will help the Reserve Bank of Australia to keep interest rates unchanged in the months ahead. So labor force participation fell to 66.7% from the previous 66.8%. I guess that's a mixed result. For the market impact, we did see Aussie dollar dropping 0.4% instantly in reaction to that big jobs number. It continued to fall a few hours after, but it has since recovered to almost the same level as it was before the number. And on the hourly charts, we see support at the psychological level of 66 cents and hourly resistance at 0.6710. So it's just slightly above the 67 cents level. And of course, as mentioned, the prevailing topic that was concerning most investors on the week was the discussions on increasing the US debt limit to avoid a default before money runs out in early June. So there were some encouraging signs that it was heading towards the right direction. The Republicans, for the first time, sounded positive that they could resolve the issue before the deadline. So as a result, US stock markets did well on the week. What's important this week? Overall, again, the US debt ceiling discussion negotiations will continue, and that should likely be the key driver of risk sentiment for the week. But on the data front, Tuesday we do have the US Global Purchasing Management Index, and it's likely to show that the sector continues to grow, meaning a print above 50 is growth, and we're likely to see that. And for services, it's a 52.6, so slightly better than the 50. On Wednesday, the Reserve Bank of New Zealand is expected to raise interest rate by 0.25% in its monetary policy decision, likely to cite inflation is still sticky and they still have to consider hiking interest rates and possibly more interest rates in the months ahead. And the US Federal Reserve May policy meeting minutes will be released. There's unlikely to be any surprise there, but hopefully we will get more insight into how close they are to a pause in their rate hike cycle for the next meeting. And on Thursday, we have US GDP data likely to show 1.1% growth on a quarterly basis. It's unlikely to have much of a market impact, but if a lower than expected number, if significantly lower than expected number, may dent risk sentiment if it should increase its recession fears. However, the more important data point of the week from the US would be the US PCE price index. That is the US Federal Reserve's preferred measure of inflation. It is expected to show that prices rose at a 4.3% pace year on year, same as the previous print, but the core index, which excludes the more volatile components of energy and food prices, is expected to show 4.6% increase year on year. However, if we should see, which as we have been seeing of late, a slightly weaker than expected number or a significantly weaker than expected number, it would be good for risk sentiment, as that would increase the likelihood that the US Federal Reserve will keep interest rates unchanged in their June meeting. Yes, that's it for the week, and I hope you have a great week ahead. Enjoy the trading week, and as always, stay true to the process. Eventually, you'll develop habits that will lead you to success. Take care. Bye-bye.